Well, good afternoon. Thank you for coming to the panel on equity trading. Over the last few years, consumption of headlines about flash crashes, botched IPOs, dark pool investigations, and a famous author has dominated the perception about equity market structure. So today, we have 5 esteemed panelists who are going to talk beyond the headlines and provide you some insight on the current market structure issues. So if I could have the panelists, starting with Kevin, introduce yourself, your title.
Sure, I'm Kevin Cowan, president of TSX Markets, which includes Toronto Stock Exchange, TSX Venture Exchange, and our alternative trading platforms.
Hi, I'm Stephen McCauley. I work at Winton. We are a large systematic investment manager, and I head up research there.
I'm Seth Marin. I'm CEO of LiquidNet.
I'm Sayana Mustofi. I'm head of U.S. equities research at Tab Group.
I'm Jamil Nazrali. I'm head of Citadel Execution Services.
And I'm Jatin Suravanshi. I'm global head of quantitative strategies at Jefferies.
Great, thank you guys for being here. So before we start, I just wanted to put some numbers out there because we've listened to various panels and I think some of the numbers are, we're getting different numbers, but I just wanted to kind of break down the equity market structure in the US. So we have 11 active US equity exchanges. They're owned by 4 entities, and we have 37 active ATSs, equity ATSs, 35 of which are dark and 2 are semi-dark, and we'll get to what semi-dark means. We have 9 retail wholesalers, 3 single dealer platforms, 3+ single dealer platforms, and 2 trade reporting facilities. So keep those numbers in mind as we move forward with our questions. And about a year ago, the chairman of the SEC, Chair White, put forth 13 directives in order to improve market structure. And so before we move on to what's going to happen in the future, I wanted to ask our panelists how they would assess the 13 directives she put forth, or if there were particular items that they feel were beneficial over the last 12 months or are going to be more successful in the upcoming 6 months.
You just had a meeting with her.
Well, I'll kick it off, and I know just from some pre-panel discussion that there may be a little bit of controversy around this, but by and large, I've been relatively impressed with the way that the regulators are responding to all of the headlines. And there's a great possibility for discussion that is charged by headlines, and with the 13 directives and a lot of the priority in there on transparency. For example, I think that there's a great commitment to evidence-based policymaking, and that's something I would really encourage.
Yep.
So if I could say something, first of all, I find it incredibly encouraging that there are nearly as many people up here as down there. Because I actually think that equity market structure in the US works incredibly well. Retail investors get a better, faster, cheaper trade than ever before. Institutional investors have seen their transaction costs come down dramatically over the last 10 or 15 years. And I think that recently, partly because of a book published by a well-known author, US equity market structure has been in the news a lot. And it's gotten a lot of attention. And if you attended last year's panel here, it was in a much bigger room and it was jam-packed. I think the fact that the headlines have died down and the fact that the SEC is continuing to deliberate, take a very data-driven view of improving equity market structure, I think that that's the way it should be. And it shouldn't be in the headlines because it is actually one of the most efficient facets of our capital market. So I'm really actually happy to see that.
So this is why they have Jamil and me on the same panel. So the 13 directives of Chair White are basically beating around the bush, beating around the edges. It's like cosmetic facade changes. And even so, they haven't done anything about it. And it's not just the SEC's fault, because Congress basically dumped a whole bunch of crap in Dodd-Frank with fill in the blanks for the SEC to complete, and they didn't author it, and they didn't have anything to do with it. They didn't even want it, and they're still trying to fill it out. I think it's only 2/3 complete or something, from what I understand, so that they still have a long, it's 5 years overdue already. But I would say that it's not that we have a terrible market structure, and it's not that the markets are themselves terrible. I think that there's been a lot of efficiencies that have been introduced, and the sky is not falling. But that doesn't mean that there isn't room for massive improvement throughout. And I think that the SEC's function ultimately is to create markets that are very efficient, or any regulators, create markets that are very efficient, to instill and maintain investor confidence in those markets. And the SEC's standoff approach in terms of not really stepping in at all, their measured approach is like, do nothing, right? And I'm not for huge amounts of regulations, but there are places for the regulators to come in. I'll give one example that I've used in every one of these panels. There are 57 different order types, each one of which the SEC had to approve of, right? So I'm not that smart. I know that there's a buy and there's a sell short, and there's a cover. I don't know what the other ones are, except that I know that there are a whole bunch of firms that are so. That a whole bunch of them are so unique in their application that only certain firms who have asked for these order types can use them. I don't think that's necessarily fair access, and I don't think that's necessarily creating and instilling investor confidence.
Well, I think
We're not getting off of this topic here. This is it. This is one question and we're done.
Yeah. I apologize because I don't want to be a panel hog, and I'll try and make my point really quickly. I think where Seth is coming from, there's a lot of complication in the market. And in Canada, one of the opportunities that we have is what I would sometimes call second mover advantage. So we get to watch what happens south of the border in the most innovative capital markets in the world, and then maybe make some choices. And we've made some different choices, and it does go around fragmentation, customer segmentation, custom order types, and those kinds of things. But I do want to echo one thing Jamil said, that we're here talking about trying to take the world's best markets to perfection. And I won't for a minute say we're not there, but I think it's really important to keep in mind when we talk about equities markets that these are the only markets in the world that give you a best price guarantee at this kind of efficiency of price discovery. Everything else you buy, whether it's currency for a vacation, gold, silver, a particular brand or model of a car, you will never get this kind of efficiency. So it's not like we can't get better, and we should strive to get better, but these are very, very efficient markets, the world's best.
And I just wanted to shed some light for those of you who are not intimately familiar with the 13 directives. There were essentially 5 topics. There was preventing market instability, addressing market fairness and high-frequency trading, and enhancing transparency, mitigating conflicts of interest, and building quality markets for smaller companies. I do want to get to, speaking of Canada, to the building equality markets for smaller companies. But before we go there, I do find that my role is sometimes to insert some facts that may help enhance the conversation. And in terms of order types, some of the exchanges, New York and NYSE in particular, have decided to put out metrics with their volume per order type. And for New York in particular, their top 5 order types is 80% of their volume. And for NYSE ARCA, their top 10 order types is 80% of their volume. So I think what we should be encouraged is that these 2 exchanges have put those metrics out there, and we would hope that the other exchanges were to follow, which would also go in hand with providing empirical data, which is one of Chair White's directives, creating the market structure website. But speaking of things that are in the near term, and one of the items on her list is building stronger markets for smaller companies. And it feels like there are 2 phases to this that are ongoing. The one item she had outlined was the tick pilot. So I wanted to ask our panelists what their thoughts are on the proposed tick pilot. And the second part is there have been mentions of a venture exchange model in the US. So I wanted to also receive your feedback in terms of where you think that's headed. And maybe we can learn more about that as well. So whoever wants to tick pilot, is it a positive thing? Is it a negative thing? Do we need it at all?
I mean, my view of this is that the SEC
I like to
instituted
go after Jamil, just so you know.
the SEC instituted the tick pilot for one reason, and that's because they had a lot of congressional pressure. You know, the Duffy bill passed; it was overwhelmingly bipartisan, and there's this idea that I think is ill-formed that somehow by having a wider tick size, we're going to go back to a world where market making is bundled with research, and that market makers start to cover smaller companies in research, and that leads to more IPOs. Anyone who really understands the market realizes that that is pure fantasy. I have not met a single market practitioner who believes that that's going to happen. Having said that, there are some smart people who feel that wider tick sizes is going to result in greater liquidity, which is going to allow people to trade these smaller cap stocks. And that could be a good thing. One part of the tick size pilot that we are vehemently against, and I think most of the industry is against it, and Seth, I'm sure, is for it, but you'll hear from him in a sec. But one of the parts that we really oppose is there is a provision in the tick test pilot called trade at. And trade at essentially directs all orders to the exchange. Now, you can understand why the exchanges pushed for that, because particularly New York and NASDAQ over the last 10 or 15 years have lost a lot of market share. And this is a great way for them to get the market share back on exchange. We really dislike that because it reduces competition, and it impedes the ability of off-exchange players to provide customers with better prices. Now, fortunately, the SEC in that tick test, in that trade at provision, exempted retail orders. And I think that there was a very strong recognition that retail orders are best served and get a better execution by having the competition of off-exchange market makers. So that's the long answer.
Yep.
Tick size pilot, bad. Trade at, even worse.
But exceptions, good.
Exactly.
I think that this is, and I will agree with Jamil on most of it, but this is an example where we're just getting way off base and we're focusing on something that is just ridiculous. It's a bad solution to a bad problem, as opposed to really concentrating on things that could structurally make the market really more efficient. This is aimed to address the fact that there's just a dearth of liquidity in the marketplace, and even more so, obviously, among the smaller cap stocks. So this proposal really did come out of an investment bank, didn't come out of a research house, came out of a venture capitalist who said, I can't take my companies public, and I certainly can't sell the rest of my stock out there because there's no coverage and therefore there's no liquidity. So what is the solution? Let's increase the tick pilot, and because market makers will make more money, there should be more liquidity there. And if there's more liquidity and they make more money, then they'll create research. But the fact is that that's a very 90s mentality, because the investment banks are not going to produce more research for the small cap stocks, and the current market makers don't do research. So it's just an absurd proposition that's actually going through because of some politics, really, I think.
Yeah, I think one thing I would say about we at Winton have in excess of 100 researchers, so I don't need anybody else to pay for our research. We do that internally. We follow liquidity. I mean, I would echo what the other panelists have said in terms of our general perception and interaction with the US equity markets is very efficient, and we're very satisfied with our costs. And of course, we have to work very hard to continue to improve that. But don't feel sorry for us. That's part of our job. Anything we follow liquidity. So if I don't have a firm view on the tick pilot.
Yeah.
It sounds like my fellow panelists are generally against it. But perhaps if it did lead to greater liquidity, then that would help us because we follow liquidity. And I think one other thing that I do like about it, leading to kind of this data-driven or empirically led conception, is that it does have a date of death, which I think is very good. Yeah, if it's a good idea or if it's a bad idea, irrespective of that, it's very pragmatic that it will expire and we will have a period to examine the data.
And I think one
Like
of
the negotiations with Iran, and that'll with a line in the sand. Or
No,
what?
I gotta say I don't have. It's better than some
I
carte
agree.
blanche,
I agree.
Right, and-
directive which is permanent.
And I think where Chair White was coming from is that she was recognizing that a one-size-fits-all market market structure does not work for every type of security, just like the execution quality can be different for a retail firm and an institutional firm. So, Kevin, would you mind talking to us a little bit about different types of market structure depending on the type of securities?
Sure. I mean, I think I'd echo what was being said here before. I think the challenge with the tick size pilot is it's being seen as a panacea for small and mid cap. Bringing small and mid cap capital raising back to the public markets for SMEs in the United States. And I don't think it will be a panacea. I think if you're going to build a vibrant venture exchange, you need a whole bundle of tools to do that. And I think also that unfortunately, at the heart of what's going on with the tick size pilot, I don't think the public debate's been strong. I mean, what it effectively is, and I think Seth was getting at this, is a policy-based intentional wealth transfer from the investor to the dealer. That may not be a bad thing. That might be a good thing if it works in terms of getting those independent and boutique dealers to support small and medium enterprise right from the investment banking stage right through to the trading stage where we're all seeing the challenges. But I think years ago when this was first proposed, I think by David Wield and Grant Thornton and some of the other studies that were done, there was way too much focus on just this one tool. I think if you're going to build a very vibrant public market for small and mid caps, you've really got to look at lots of different features. Tick size might be one or might not be one interesting thing, but it's really about putting in place a regulatory regime that's proportionate in terms of the requirements and burdens on those small and mid cap companies.
So we're hearing,
Just
go
from
ahead.
the perspective of
Yeah.
execution, we've always felt that, if you just divide these stocks into the ones which are already trading at spreads wider than the tick size, with a 5 cents tick size, they're not really going to collapse in. And the ones which are trading in, we're basically making them trade out. So maybe there'll be more pockets of liquidity at those levels. But from a trading perspective, it's going to become a battle of, the only way I can express my aggressiveness of execution is from posting at the bid to lifting the offer, paying another 40 to 50 basis points, depending on the price of the stock. And that ability to trade or not to be able to express the aggressiveness is going to cost the execution and might also increase market impact. And the opportunity cost of missing or not lifting an offer when you should have is actually now even higher because now you're basically trading 5 cents higher. So from our perspective, it is going to be a little bit more expensive to trade in that regime.
I also was just going to add to one point that Jamil raised. Because I'm from Toronto, I can be slightly more sympathetic to the SEC, but I was originally very confused that they put trade ad and the tick size pilot together. Seemed to be confusing variables to me. I guess I'm more willing to take them at their word that it's really intended as one control variable within the tick size pilot, but I guess time will tell.
So all of this in the name of execution quality for those particular stocks. Jamil, maybe you could tell us just execution quality in general. Is some best ex a topic that's brought up in every single market structure issue that we have? And best execution for the institutional investors versus the retail investor. Could you give us some, at a high level, what the major differences are in terms of when folks are looking at execution quality, how they're looking at it because not only are the stocks different, but also the market participants are different.
Right. I think there was a sea of change when the SEC introduced Rule 605 and Rule 606, which resulted in additional disclosures for retail investors. So 605 required market centers to publish a number of statistics on execution quality for the orders that they executed. So things like price improvement percentage, price improvement cents, average quoted spread, et cetera. So it allowed, it created this mechanism for firms to evaluate whether or not the market makers that they're sending the orders to were doing a good job on those orders and giving them quality executions. I think that what that led to over the next 10 years was a dramatic improvement around execution quality. And there's a Barron's reporter about a month ago that looked at execution quality for retail investors, and he found that that literally tens of millions of dollars a year are being spent on price improvement, giving retail investors a better execution than the best bidder offer. Now, in meeting with the SEC, I was there last week. One of their big concerns is that there's no analogous disclosure for institutional investors. And a lot of institutional investors don't really know how their orders are being handled. And I think that that lack of data makes it harder for them to make decisions. And I think that there are some really great off-exchange as well as on-exchange liquidity providers. So, Seth's company, I think, does a really great job of crossing natural liquidity. I think there's other market makers, Citadel has a product, Citadel Connect, where we provide liquidity off exchange. But because there's no standardized data that has to be disclosed on institutional order routing, it's difficult for institutional investors to really evaluate the different venues. And some of them then take the default option as, I don't know what's going on, send everything to an exchange. And that's a really, really bad idea, because the exchanges execute about 60% of the volume. A lot of what's executed on exchange is stuff that doesn't cross anywhere else. And so if you're opting out of a large segment of the market, you are in all likelihood getting a much worse result for your end client.
So in Europe, are there uniform metrics for retail and institutional investors to review execution quality, or how do you guys go about doing it?
I think that's proprietary. I think everyone, it's part of your business. For us, transaction cost slippage monitoring.
It's not just about price.
Not just about price, it's about impact, which is a function of liquidity and a function of the size which you're trying to push through the markets. Slippage is something which you pay with very high probability, whereas expected returns or your forecasting ability is something which you only know in expectation. So for us, there's an interesting balance and counterplay between those. I think it's your own responsibility as an institution to monitor your slippage, to model it, and to take all pragmatic steps to minimize it. And we take that very seriously. And execution and slippage analysis is one of the thrusts of research at Winton. For sure, it's a second-order consideration, but if it's something which you get wrong, that second order accumulated over time can quickly become first order.
Got it. Anyone else?
In terms of execution quality, especially when working in institutional order, large-sized, there are so many components to working that order. It's half of it could be providing liquidity, half of it could be removing liquidity. And when it comes to removing liquidity, it's kind of easier to measure. If there were 5,000 shares offered, were you able to get those 5,000 shares? It's more quantifiable. But when it comes to the liquidity providing aspect, where you post, which order type you use, go to the dark pools, you go to the exchanges, that's where everything gets a little gray, and I think that's very hard to measure. One of the things which we've tried to do is to quantify everything in terms of information content, in terms of the ability or understanding the order types, understanding the rebate structure, trying to take advantage of what the market information has, and to be able to basically design algorithms which are trying to take advantage of that. Just to give an example, inverted exchanges, the rebate structure is totally opposite. You can realize that a smart router would actually go to the inverted exchanges first in order to get that rebate. So if you're a provider of liquidity, you might as well post on an inverted exchange to get the first look on order flow. So those kind of things we have to build in the algorithms, and the market structure makes it even more fun, I guess.
So one of the differences in the U.S. versus other regions is we have this on-exchange, off-exchange regulatory boundaries. So we have the retail wholesalers who provide enhanced liquidity, price improvement, payment for order flow. they operate off exchange. And other regions like Canada, you guys, there is no such thing as a retail wholesalers. Would you guys kind of be able to kind of assess the pros and cons of being on exchange versus off exchange?
Who goes first, Jamil or myself?
Who's doing it better? Is it the U.S.? Are you guys watching us and saying, in a few years that's what you're going to implement, or do you think they're doing it better?
So, to your point, in Canada, there is the equivalent of a trade at, which means that unless you're price improving by half the spread or a penny, you must trade everything on exchange. Now, the result of that is that sophisticated institutional investors get a better execution and retail investors get a worse execution. And the reason for that is because market makers are often able to give a much better price to retail investors than they are to institutional investors. So when you have to give the same price to everyone, you're going to give the people that would otherwise have gotten a better price a worse price, and those that would have otherwise got a worse price a better price. Why do we give retail investors a better price? Well, because they tend to be trading in smaller size. So if a retail investor is buying 500 shares and I sell them 500 shares, I can usually do that at slightly better than the offer because that 500 shares is that investor's order in entirety. If the same thing is happening with an institutional investor, they might have 100,000 shares behind it. And so I'm very wary about selling that 500 shares at the offer because I could get rolled over as they do their larger trade. So I think that when you force everything to blend together, the retail investors do worse. And one of the things that you're seeing is that in Canada, there are a number of companies that are interlisted both in Canada and the U.S. So there's a company that trades in both places, and it's often cheaper for a Canadian investor to get their order routed to the U.S. and get that price improvement than it is for that order to be executed in Canada. Now think about that for a sec. It's actually cheaper for a Canadian retail investor to have their order routed to the U.S., to pay the FX exchange rate, and to execute down here and pay the increased clearing cost than it is to be executed in Canada. I think that shows, how retail investors are harmed by trade at. Now, to TSE's credit, they're working really hard to create a second venue that will allow retail investors to receive additional price improvement from market makers so that they can fix this problem of allowing retail investors to get a better price, but have a second mechanism to do that.
Market segmentation on exchange. And Kevin, I do want to allow you to.
Yeah, sure. So I think there's two things that we've done very differently in Canada than the U.S. The first is our use of venture exchanges, and the second is around off-exchange and/or dark trading. And I actually, in terms of how Jamil outlined it, I have very little difference of opinion in terms of how Jamil's outlined the facts. I think he's done a good job of outlining the facts. I think, though, from our perspective, what we did is on a public policy basis, we said there's execution quality, but are there also market quality issues? And we had a concern as we watched in the United States with not only the fragmentation of trading, but when you started hitting numbers like 40% of all trading occurring off exchange, which effectively is being pegged to the prices that are in the public market. At some point, you suffer deterioration of price discovery because so much is moving off the exchange. And it was interesting to watch the debate in the United States because so many people supported this in the early days who then later changed their mind and said at 40%, too much is off exchange. So that's the view we took in Canada. From a public policy point of view, we wanted to keep more trading on the exchange. The second thing is the context is maybe a little bit different because it follows the general rule of thumb. The U.S. 10, Canada 1. Your equities markets are about 10 times larger than ours. So when you start having 40, 50% of your trading occurring off exchange on a base which is 1/10 of what you see in the United States, I think then the problem is further exacerbated. So I think it's a fundamental public policy difference.
Let me just insert some stats in terms of, people say off exchange, on exchange, and I think the assumption is that everything that's on exchange, so every stock that's a NMS stock, a national market system stock in the U.S., has real-time reporting to the consolidated tape. And the difference between on exchange or off exchange can be that there is no pre-trade transparency or there is no pre-trade transparency. But there are stocks, there's trading on exchange that's also dark. People equate off exchange to dark, but there's also dark trading happening on exchange.
Yeah, I think that's a great point, and I think the two issues are sometimes hard to
Intermixed,
disentangle.
yes.
Yeah, because they are certainly related issues, off exchange and dark. In Canada, our total dark trading would be 5 to 8%. Very, very different than the United States. But we do offer on-book dark order types that interact with our lit volume on the exchange.
And so in the U.S., the number is from the fourth quarter is 43.3%. And the breakdown of that is...
That's dark or that's off exchange?
That's dark. And I'm going to break that down is 16.7% is retail wholesalers, 13.8 is dark ATSs, 9.6 is hidden on exchange, and the remainder are the single dealer platforms that we were talking about. So 9.6% of the dark volume is actually on exchange. So the distinction, becomes blurred in terms of, it becomes a regulatory boundary.
It definitely becomes blurred, for sure. And one other thing Jamil referred to, in Canada, a broker cannot pay for order flow. In the United States, you can. So there's an opportunity for regulatory arbitrage there. And I was pleased to hear that you referred to, we are launching a new market in September that's designed to help Canadian retail desks, get the same kind of economics you get in the United States. And we look forward to Jamil's firm making markets there.
So do you guys...
Just one clarification. Kevin is right about the payment for order flow, but the interlisted that I described before, that happens without payment for order flow. So those customers are being routed, in absence of payment for order flow. So just wanted to clarify that. Yeah.
So for the dark, so you seem to be, there seems to be a notion there that there's a magic number where, once you reach that dark activity, then it should stop. So 40 is too high. What's the right number? I gave you a 9.6% for exchange hidden. Maybe that's too high. So my question for the panelist is, should dark activity be limited on exchanges or even off exchanges?
It's not a percentage question. It is, and this is what regulators all over the world are coming to understand. And, a dark pool was created not for retail trading. It was created for institutional trading. Institutions, if you want to execute 1 million shares of something, you need different tools than if you want to execute 100 shares of something. So dark was created to provide the anonymity, the size, the pricing difference, something above and beyond what can be found on the exchanges. The exchanges have always been the pricing mechanism in the country, and the pricing mechanism is sacrosanct. You have to protect it. It's got to have its integrity. But what has occurred over the years is that the proliferation of all of these ATSs, these dark pools, is that their average execution sizes, when you delve into it, are actually smaller than what's being executed on the exchanges. Found in Canada, found in Australia, found in the United States when the SEC started looking empirically at their data, right? There's no reason to have 40 different shadow exchanges competing with the exchange if you're not providing value above and beyond. But the fact is that institutional assets have grown 40 times in the last 35 years. In 1981, the whole institutional sector was $220 billion. Today, Winton's firm manages $30 billion. It would have been like, what percent of the market? But you have these large institutions, and they need some place to trade, and they need different tools. So, what you need is a safe environment for institutions to be able to trade, and trade in the size that they want, and not have all these different dark venues that are not providing value above and beyond. Do something that's complementary. Do something that is additive. Do something that, in fact, benefits both retail and institutions.
I should hasten to add just quickly to clarify, in Canada, what we've done in terms of the rules that Jamil referred to in terms of our equivalent of trade at is just for smaller size orders. So for example, the traditional use of dark pools to move very large blocks of stock without market impact, like LiquidNet is doing, those are exempted from our rules.
So to answer your question about, is 40% the magic number? I'm not sure, but if you look at the reasons why a lot of trading is happening off exchange, I think there's 3 primary drivers. The first is the access fee of trading on exchange. While it hasn't grown over the last 10 or 15 years, what's happened is the cost of trading has come down dramatically. So 15 years ago, it may have cost, 4, 5, 6 cents for an institution, 4, 5, 6 cents a share for an institution to execute an order. Today, it can be 1 or 2 cents, or sometimes fractions of a penny, in terms of an algo execution. And so that 0.3 cents fee for accessing liquidity on exchange has really become a very significant portion of overall costs, which drives a lot of activity for firms to cross as much as they can in the dark before it hits the exchange, so they can save the access fee. The second reason a lot has shifted to dark pools is that the minimum tick size of a penny. There are a lot of low-price names with high liquidity, like Bank of America, where people really want to trade in between a penny. The natural rate of trading would happen in fractions of a cent. And so a lot of the activity you're seeing in dark pools is actually people who want to trade those stocks in between the spread. And I think if you cut the minimum tick size, you would see automatically a lot of that trading migrating to the lit venues. And then the third reason is the whole reason dark pools were created was really a mechanism for institutional investors to execute their orders and post liquidity without the rest of the market seeing it. And so I think that's a lot of the reasons why you're seeing these really small order sizes, average order sizes in the dark pools. But if you think about how we solve that problem, you have to recognize what's really driving it and then prescribe the appropriate policy to address it.
And I think the definition itself of a dark pool is it has multiple meanings. I mean, you could have, as Seth said, you could have blocks trading in it, but I think the equilibrium is going to decide how much volume trades in the darks. Eventually, when we write an algorithm and we talk to a client, the client's really, really happy about trading in darks. I mean, they're saying that if you can keep me in the dark pools and get me done, it's a much better execution for me. I see less impact. So there is some value to be had, and I think if that keeps growing, that number may increase. But at a certain point of time, when you don't find the liquidity, what is the alternative? You go to the exchange. And that's kind of where I think, Jamil, you referred to earlier about the more toxic flow, the more informed flow, or the more flow which is not being able to cross is going out to the exchanges. So the execution quality is slightly inferior in that respect. To the access fee rule, I would take both sides of that. I think that the 0.3 cents fee is applicable. But again, you have to look at the other side where you get the rebate on a passive order. So there is kind of a mix of both rebate and removal fee. So on the average, your fee slightly could be less on docs, but it's not that much of a difference.
So I want to just comment on one thing you said. Jayton makes a really, really important point there, that if there's any institutional investors in this room, I think is worth underscoring. And that is, he's very data driven, and he's looked at all the quantitative analytics. And I think that firms that have done that have realized that you do get a really good execution if you avail yourselves of all the sources of liquidity. If you're just trying to send everything to the exchange, you're likely getting a worse execution. And so, I would strongly encourage firms to look at the data and to evaluate the various venues that they execute at.
Australia and Canada, they've put rules in place where it limits off-exchange trading. Is that kind of targeted regulation?
And Europe.
And well, soon, not yet. Would the U.S. benefit from that type of targeted regulation?
I think it relates back to your 40% point, and at what point is too much occurring off exchange. And that number might be different country to country, and certainly with the U.S. with the the biggest and deepest equities markets, that number might be different. But certainly at 40%, I get very worried.
So I will move to Canada after I make the statement. But yeah, you take a look at what Canada has done in addressing. Look, we are a very global firm. We deal with regulators all over the world, and the top two issues that regulators are dealing with are dark pools and high frequency trading. And Canada addressed both of them and addressed them very simply, simple to monitor, simple to implement, and got the results, the intended results, right? Europe, on the other hand, with all these different countries chiming in, you have to bend so far over backwards to try to figure out what the hell this is going to, and we kept on telling him, look at Canada, go to Canada, live in Canada.
Live in Canada.
Sounds like a South Park movie.
And I think that more and more people are actually taking me up on it. Right? But what they did was they said, look, if you're going to trade in the dark, make it at least 5,000 shares. That's not even a block, right? And they put some price constraints on it too. And they said, if you're going to take up all the bandwidth, we're going to charge you like a phone company, right? You're going to have to pick up some of the cost for that.
How would you
Wait,
then?
I'm sorry. I have an opinion I want to express on this.
No way.
So I think Kevin said it right, that this is really a public policy decision. But I will tell you what would happen if you instituted a trade in the U.S. like is in Canada. And this is not a subjective opinion. This is actually it's pretty clear what would happen. What would happen would be retail investors would get, on average, worse execution prices for their orders, and institutional investors would get better prices. And you would have a huge transfer of wealth, probably more than $100 million a year, because that's the amount of price improvement retail investors now get for their orders, which they wouldn't get. There'd be a huge transfer of wealth
But that doesn't
from
take
retail
into account
investors.
the amount that the institutions have to pay, right? So,
So, yeah, I mean, there would be a transfer of wealth between retail investors and institutional investors. And I guess as public...
Who do institutions invest on behalf of?
Well, I mean, it's a public policy decision, right? Do you want to prevent firms like ours from giving a better price to a retail investor because their order is smaller and you can give them a better price on exchange? Do you want to prevent that and force all the liquidity on exchange, and force firms like ours to give everyone the same price? And it's a public policy decision. I mean, you could say, okay, well, a lot of the large institutional investors are investing on behalf of retail investors, right? There's pension funds, there's 401ks, et cetera. But not all of them are. There's a lot of hedge funds out there. There's a lot of insurance companies. There's a lot of firms that are institutional investors that are not investing on the retail. And I think regulators and policymakers just have to deal with that public policy decision of, is that a good thing or bad thing to create that transfer of wealth from retail to
Jamil, is there a
institutional
point,
investors?
sorry, just quickly, is there a point at which you worry about the quality of price discovery, in the sense that it's almost perverse, in the sense that, because we all know that whether there's price improvement or not, you have to be at least at the national best bid or offer, right? So you're pegging to that. So all of this dark trading is being priced off the price discovery in the visible market. And if that proportion continually goes down, we have this perverse situation where more and more dark is being priced off a smaller and smaller quality of price discovery.
But you have to remember that two of the things that are driving that are access fees, because people are trying to trade off exchange so that they don't have to pay the access fee. And two is they want to trade in between the spread. So I think if you made those two changes, immediately you would see a lot of liquidity migrate to the exchanges. If access fees went down from 0.3 to, say, 10.
10?
That's a place where the SEC could actually get involved.
Yeah, exactly. I mean, that's something that the SEC, that will be an item of discussion. But I think that you would see this dramatic movement. And just look at the stocks that have the highest degree of trading off exchange. It's stocks like Siri, Bank of America. It's low-priced, high-volume names where people want to trade. If you look at how much of Apple trades off exchange, it's really not that high a percentage.
So just to put,
Just
go
one more thing
ahead.
I'd like to add would be that I think just treating dark and displayed or exchanges as two independent entities is probably not the best way to think about it, because there's a lot of interlinkages between the two. Liquidity flows from one to the other, and market makers, even algorithms, they're basically executing over time, and they're checking for dark liquidity. And if I'm interacting with the market maker in a dark pool, that market maker's position is going to express itself in the lit markets eventually. So when we say 40-60, they're not really independent of each other. There's a lot of linkage, tight linkage between them, and we need to understand that.
And absolutely. And speaking about price discovery, even though we use the term dark, it doesn't mean that when the trade occurs, it's dark. So that
It's
the
pre-trade,
trades are, it's pre-trade. So some could argue that price discovery happens off of trades as well as.
Yeah, I won't, just to be clear, I wouldn't deny for a minute that a post-trade transparency of an executed order also contributes to price discovery.
Yep.
I just think it's a different part of the chain.
Sure.
Price discovery is supply and demand.
So, right, so to your point earlier, you said 9.6% of all volume is dark on exchange.
Mm-hmm.
I would venture a guess that most of that is at midpoint. Right? I don't know the statistics, but I bet 8 or 9% of that 9.6 is at midpoint. What does that tell you? It means firms want to trade in between the spread, and they're posting an order at midpoint on exchange.
So I just want to shift a little bit to, we define transparency in terms of, we have a laser focus on market centers, how they function, whether they're lit, whether they're dark. That's our definition of transparency. In Europe, they're very much focused on transparency as well, but they're looking at it in terms, they're putting their asset managers under the microscope in terms of their costs and their execution quality. And there's a very significant change that's coming up in terms of whether they're going to sever the link between research and the payment of commissions for trading. So I just wanted to ask our panelists, how could a link between, first at a very high level, how could a link between research and commissions induce conflicts of interest? And if we could talk about it in terms of Europe, whether you see it happening there, and also in the U.S., whether that would also be applicable.
So we've seen, and we've all heard that, the asset managers, as you know, they charge a fee for managing your assets, but the commissions also come out of all of our pockets, not their pockets. So, there have been, when times are flush, a lot of research analysts would get 10 reports on IBM or Apple, right? And they'd have to pay in transaction fees to all these different people. So, the use of the discretion of what was useful and what they wanted to pay for was not looked at quite as closely as if it were coming out of their own pocket. So that is the inherent conflict of interest in using somebody else's money to pay for your core competency, which is, it's only in this industry could I ask you to pay for the stuff that I need to do my business so that you can pay me more, right? So cutting down on that makes a lot of sense. The other conflict of interest is that, in what other industry do you get a research report and what I pay you varies based on how much I'm trading, right? So it might cost me $10,000 one year and $100,000 next year. You didn't do any more work for it. No other industry. Tab Group should charge that way, you give me some percentage of your revenue every year and I'm going to continue supplying you with reports. It just doesn't make any sense. Every other industry sets a price for whatever, and that's the price. You don't pay more for it. You don't pay less for it. That's what you pay. So I think that Europe is trying to get at that. The problem is that the entire industry is built around this process, right?
Yeah.
It's all of Wall Street really is built around the active management and servicing them and providing them with this research and providing them with corporate access. And you think about all of the protected interests, and whole parts of New York City will disappear, right? if this thing goes away. And I'm not saying that it's necessarily good or bad. I'm always concerned about what the European regulators are ultimately going to do about it. I think that the interests are so vested that it's not going to happen in the way that MiFID II looks like it's going to unveil, is that you have to have explicit pricing, which I agree with, but you can use commissions to pay for that research.
Anyone else have so a lot of the firms that I'll just share, we interview 92 buy-side firms, not annually for this particular report, and even though this regulation may not occur in the U.S., a lot of the U.S. asset managers are going through ring fencing and how to harmonize their compliance across the regions. So it's actually quite a significant change, even if it never, lands in the U.S. Another topic that's being discussed is ETFs and what challenges active asset managers are facing with the growth of ETFs, whether it's in Europe, U.S. When they're looking at costs, performance, and how does it impact capital formation?
ETFs, there's never been in the world of investing such a large concentration of money and so few assets, right? So this is the systemic problem that can occur, right? So you have little problems. You have somebody who's hiding down in the basement of their parents who can actually affect the entire world, right? Because of some E-mini futures that we thought it was somebody in Kansas, which we thought was bad enough, right? But actually somebody in the basement. And this is what happens with this massive concentration in wealth. And then you have so much money that's actually coming into some of the indices, the ETFs of some of the smaller cap companies, that there's such massive price fluctuation due to nothing that the company is doing and nothing that the market is actually doing, but simple redemptions or additions into those funds. And then, if you talk about capital formation, the problem with the passive, one problem with the passive money is that they do not add to capital formation. If all the money goes into this passive funds, then who's going to be buying the IPOs and the secondaries and assisting in the capital formation? I don't think that's going to happen. But we do have to understand that the market structure itself is shifting and changing. And over the last year alone, you can see the acceleration of money going into the passive funds out of the active funds. I think it was like, I don't know, it was $260 billion into the passive funds, and something like $80 billion came out of the active funds. Now, I think that the active managers have to get their act together and start outperforming, I've told them for a long time that high cost and low performance is not a really good business model for a sustained period of time. So that they have to do something about it.
I think the numbers are starting to get to the point where the active managers do need to pay more attention. I mean, I think Seth raises a good point in terms of capital formation and where is the money coming from. We're certainly experiencing that. Canada's been a little bit behind the United States in the growth of ETFs. They're great, obviously a great product, but as part of the bigger transformation that's going on in wealth management, as people move, to asset gathering, aging population, people looking for yield rather than equity, and those kinds of things, the decline of the stock picker is a really dangerous, systemically dangerous issue on the capital formation side, and we certainly need to keep our eye on that. And that's why when I talked earlier just a little bit about venture exchanges and the independent brokers, those are the only ones left, certainly that we see doing active stock picking and keeping that capital formation part of the industry alive. So we do need to solve that.
So I have more questions for you guys, but I just wanted to open it up to the audience to see if you guys have any questions that I may not have thought of. We have an entire globe you guys can ask about. Okay. So anyone? Okay. So I just wanted to touch on one topic that was very hot last year was market data. And we're talking about improving the structure of the market centers. We're talking about improving the structure of how the the buy side is looking at their costs, but there's also the cost of market data. And so the question I had for our panelists is, what are the areas of improvement for the dissemination of U.S. equity market data? We have the SIP, we have depth of book, private data that's coming from the exchanges. What would you say are areas for improvement in terms of?
Well, I think the biggest area for improvement, I mean, there's some things that are being done now to make the SIP faster. The SIP tends to be the feed that most firms use. Some firms get direct feeds from the exchanges, but the SIP is, the standard industry feed. I think there's an initiative to speed that up and close the performance difference between the two. I think the most important issue around market data is that exchanges have a monopoly on providing market data. And when you have a monopoly, you tend to price like a monopoly, right? And so if I'm in the trading business, I have to buy a direct feed from the major exchanges, from NASDAQ, from NYSE, from the BATS group, and some of the smaller exchanges. And because they know that I need those data feeds to trade, they can pretty much price it at whatever they want. And they have been doing that. So there's been a dramatic growth in market data revenues for each of the exchange groups as trading has become more competitive and as they've lost market share in actual trading as volume has moved off exchange. They have been substituting those revenues for market data revenues. And that's of really, really big concern to us because it's a hidden tax on trading. It allows them to basically put a small tax on every single trade made by just continuing to raise those prices. And so I think that I think monopolies should be regulated by monopolies, and you should have the regulators put caps and treat it as such. Did you have a question, Larry?
Is that with Bloomberg?
Oh, jeez.
Yeah, I have a question. Off the top of your head, doesn't have to be particularly exact. Jamil and Jutton, you guys are brokers. You kind of need all this data. If you look at the exchange fees, is it 100%? What percent? How has market data changed? Was it 20% before? Is it 40% now? Is it
It's not hard to look at it that way. I just don't know those numbers off the top of my head. I would say that over the last 2 or 3 years, you've seen dramatic increases. So I think that many of the exchange groups have doubled their market data revenue without doing.
2014, NYSE had $253 million market data revenue.
Okay, so Paul here pointed out 2014, NYSE had $253 million in market data revenues. That's a hidden tax on all of us in trading. That's all of us are paying for that.
It's also an opportunity on some level. Was on an interesting stat that I quote about Winton. We've spent over half a millennia of man years now on our data effort. And we have more than 60, 70 people now in data at Winton. And it's not just on the market data side. But yeah, it's a real overhead. And it's not just the cost of the data on the day. It's also the ability to store that vast amounts of data and the metadata historically. So that requires enormous databases and new technology, but that's part of the future and part of our technological revolution, which we are living through and which we need to adapt to and survive.
Yeah, well, I just want to remind folks that back in 2004, when NASDAQ hadn't become an exchange, there was an opportunity to include depth of book in the SIP feed, in the Security Information Processor feed, and it's not technically impossible to do that now. And so, as we're running out of time, I just wanted to leave you with 3 dates to consider. One is May 13th. That's amongst the 13 directives, the last one is to create a market structure advisory committee. And the topic of a SIP that has depth of book could be discussed there.
Yeah, that should be the first topic that they discuss.
That's not the order protection rule is the first topic, but that's something that you can advocate for May 13th. May 6th is the date we're hearing that the tick pilot, which is also one of the directives, that is going to be, we're hearing there may be changes to the existing proposal. And then, if you can't wait that long, and by the end of the week, there's Rick Ketchum, who is the CEO of FINRA, is testifying before Congress to talk about, I'm sure cards and other regulations, but also SRO rulemaking. So those are things, if you don't like the order types, if you don't like the types of fees they're able to charge, that's something you can take action on. So with those 3 dates, I wanted to thank our panelists for their participation and your patience and your participation in this panel. Thank you.